what does it now mean to be an Aave depositor, right? It now means that the Aave DAO and the entire community is going to bat for you, right? I agree with Saul that like, hey, this probably isn't going to happen again on a $300 million size. But does this mean that like Aave is too big to fail at this point, right? Because I know that everyone's talking about how a lot of liquidity moved over to Spark, right? And how Spark's token's doing pretty well after these last couple of weeks of events, right? But I think the bigger story here is like, I'm a big fan of Morpho and everything that they're doing, right? But like, why would you go to some random curator, right, in some random pool where they're going to say, oh, not my fault. Oh, I don't even have any skin in the game here, versus going to a bank, essentially a bank style product where their equity and their team and everybody is going to work their asses off to make sure you don't lose your money, because that's
I just wanted to let you know, jail's not that bad. It's
All views expressed by the hosts and guests in this podcast are solely their opinions and do not reflect the opinions of their respective employers. Guests and hosts may maintain positions in the assets discussed in this podcast. This podcast is for informational purposes only, and nothing in the podcast is intended to be financial, legal, or even life advice.
What's up, guys? Again, thanks for making the time, especially you, Jai. You're on the other side of the world.
Yeah, thanks for having us.
Maybe we can just start with a very quick background before we jump into the topic at hand. Maybe we can start with you, Jai.
Cool, yeah. I'm one of the co-founders here at Waymont. We're one of the biggest contributors to the Royco Protocol. Royco Protocol specializes in tranching all sorts of different yield opportunities. Prior to this, I was one of the co-founders at Royco Capital, which is a lending and borrowing protocol.
OG, again, if some of you were around. Like, Lambro, did you remember? Like, back in 2022 and 21? Yeah.
Yes, 100%.
Yeah. Cool. And I will pass it to you next, Saul. Who are you? You know, I'm not going to steal your thunder. Start one of the more famous communities, so I'll let you start. Yeah.
Appreciate it. So I'm Saul. I started in DeFi in about 2021. I run a yield farming group called Yields and More. And besides that, I work for a protocol called RE, where we bring reinsurance yield on chain.
Cool. Got it. All right. So before we get started, I just want to pass it to you, Lambro. You know, like you've been also in DeFi for quite some times. You know, like, and in like our like weekly pod, like you were always like sort of like complaining about the state of DeFi yield and blah blah. So like, I just want to get your take first. You know, like maybe if you can help recap for the audience. You know, like what happened like 2 weeks ago. I mean, like it's like 2 weeks-ish now. You know, like April 1st. Like what happened with that? Like how does that make you feel and so on?
I think everyone is aware of the event. I'm just going to do some quick bullet points. Kelp DAO got wrecked. Aave created some bet that in Aave because of like, let's say, selective of certain assets. I'm not even going into detail. As a user, I think there's a few things. It's right now it's not justified to take on smart contract risk for this percentage of yield. For me, it's worse than 2022-3-ish because I can't even hope for ZK Sync would do an airdrop. Arbitrum would do an airdrop as a chain. Like back then, that was literally what I do, right? Like, I mean, last time I got wrecked in Kyber's hack, but I was, at least I got some airdrop from different chains for farming, LP or lending. But right now, there's not even hope for that. So it's a little bit hard. It just forces you to do directional trade instead. Yield farming right now is quite negative EV. It's cool to see all the DeFi bros doing this whole thing to save Aave. But it's also like, I looked into it. Can I even long Aave token right now? I see Morpho and some other guys are capturing some of the TVL after, which is good for them. But it's like Aave is become that thing that's cool to hear, but there's no actionable. And for someone that came here for money, I don't know what to do now, bro.
Okay, wow, you're starting it off with a pretty negative tone. But anyway, maybe I'll just get a quick reaction from both of you, Giant. You guys are DeFi operators, and what happened in the past couple of weeks for both of you? Is there any specific war room situation or like secondary effects that you felt personally and all of that? Yeah, maybe I'll pass to you first, Saul, in this case. Yeah,
I mean, for us, it was stopping the layer 0 bridge, right? because we didn't know what the compromise was, if it would affect our assets. So that was it for us. Besides that, it's basically just checking for secondary effects. Because okay, Kelp DAO got hit. Because of that, Aave got hit. Because of that, so many assets which have backing in either Aave or various other protocols got hit, like Yuzu, Avant, many others. So for me, it was just checking my whole portfolio, making sure we're safe as a protocol and as my personal funds. Overall, I mean, I think that lending across DeFi and protocols like Aave and Fluid has been negative EV for a while. I don't think that's a recent change. I personally wouldn't do so for a prolonged period of time. I would do so if there's high utilization and you're temporarily lending, but I don't think that's what the general more advanced farmers should do at all in terms of risk and reward. So
yeah, I'll pass it to you next, Jai. Yeah, what have you been looking, I guess, in the past couple of weeks?
Yeah, for us, the effects were limited, luckily. So we only tranche assets or we only tranche assets on the chain at which they're issued. So that way we don't deal with any of this OA stuff, at least for now. In terms of actual yield pools that were impacted, we had one of our yield pools impacted, which was Avant, which we have our vault itself has about a few $1 million in exposure to that. Now, luckily, first of all, Avant has its own junior tranche, right, which kept us safe. And then we have another junior tranche that was
it's double, yeah.
We were pretty low down the capital waterfall in terms of being affected by this, right? Luckily. Now, the really interesting thing here is Avant was able to escape without even touching their junior tranche, right? They were able to escape that negative carry, right? That was the big issue, is not actually that they lost funds, but that they were stuck in a negative carry position where they had underwritten Athena. They were down to take on all this risk around Athena, and then they were stuck because of something not related to Athena. Pretty unfortunate for them. So yeah, luckily we weren't impacted. Now, look, what does this mean for DeFi moving forward? I think it means a few things, right? It means hey, first of all, we'd like to think a lot of these levered loops will start to move to tranching, right? So you don't have this negative carry rate risk, right? If you want to go and underwrite risks on Athena with leverage, a junior tranche is a much better way to go and do that. Now, the second thing here is okay, is DeFi cooked, right? Is the chain cooked, We'd like to believe not, right? We just believe that a lot of the yields, right, are going to be coming from places off chain, right? Shout out Ree here. Instead of being on-chain originated, where you're taking on layers of smart contract risk, right? And where you do take on smart contract risk, we imagine it'll look a lot more TradFi with T+1 settlement and KYC and all of that fun stuff.
Got it. I want to expand a bit on the things that you said, like the looping, the underwriting, and how that creates some secondary effects. Maybe, Saul, when you're interfacing with LPs or I know you've been running the groups for quite some time. So, I mean, looping remains one of the core PMF for any form of tokenization, right? Like you want to bring it on chain so that you can create these demands. And then there's more interesting mechanics, whether you can argue it's risky or not, such as what Fluid is doing with it's, both LP and then use as that can help increase the supply and so on. I'm wondering as somebody who's very closely into issuing an asset, how are you seeing all of this would evolve? Is it just now that because it's not the issuer's fault, right? Your backings are fine, but how are you planning to communicate with the ecosystem players? Do you see a future in which hey, please don't loop my token so much, or what's the sense there?
Yeah. So in general, the risk of looping doesn't fall onto us. So it's not I would say don't loop our tokens. Yeah. In general, what we're seeing is risk hardening across the lending markets, which we're on / we want to get on, which is very reasonable. We also see a very not pessimistic, but very risk-off approach from creators in order to make sure that they don't get hit, which again is very reasonable, and I'm perfectly okay with that. For looping in general, Aave and Fluid are just gold. Core markets, these kind of pooled markets are just great for loopers. And in the recent weeks, that has been very complicated, very much spiked. So we'll see how looping does in the future. In general, Morpho is not the best place for loopers. There's the dynamic IRM is not so great. There's bad incentives for the curators, and so many other things we can get in. But yeah.
Got it. Yeah, no, like I would have to agree with that in terms of like just a borrow rate and so on. Lambro, do you have any comments on this before we go about, I guess, just like the next topic, which is like bailout, I guess. Yeah.
Yeah, sorry about the typing just now. I really had to reply something. But yeah, no, I got really agitated just now. Sorry. But yeah, I wasn't being okay. I think overall, I was overly bared, but like as you know how much detail I've been looking into it, I still care. I think DeFi is going in this like awkward teenager stage where it's not sexy enough for the degens, but it's not stable enough for the big boys. And yeah, hopefully let's see how everyone's view in what will trigger the next stage. Or for me as a small player, I'm waiting for the turning point, right? Like, but overall, the big trend is likely going to be created by you guys, where you guys are building the protocols, doing the next step, and maybe Marco can lead the conversation to that side where to see what the turning point is for us.
Got it. Yeah. Before we move there, I guess just quickly the conclusion of the Aave situation. I mean, it's not the Aave situation. It's a Kelp situation which hits Aave and so on, but it's much more complex. But just very quick take from both of you. What do you think of the bailout or how they're approaching this? Right? Yeah. Any hot takes there? Whoever wants to start is fine.
I feel like they can't be too openly talking about it, bro. Why are you putting them on the spot?
No, it's okay, man. Yeah, it's just like, hey, I mean, like, I'm glad that they're rescuing people, but it's just like tiny high level thoughts on like what this means, in terms of the precedent that it sets and so on.
Yeah.
Oh, go ahead.
So I think it does set a bad precedent, but I also think this is a one-off. I hope that DeFi learns from this and we don't get this kind of event again. I think that it has to be donations. I don't think Aave would be able to pay out so much, ETH back purely through loans. And a lot of the donations are genuinely through interested parties who would lose a lot of TVL if this wasn't solved, and ultimately a lot of revenue. So I think people are incentivized to donate. I don't think the hate people get, I don't think the hate, quote unquote, the hate Stani got or Michael from Curve got for being ultra rich and not donating. I don't think that's fair at all. I think especially Stani made way more than he needed to. So I think that's okay.
I would like to say I would not have donated.
This guy, okay.
Like, come on.
Anyway, wait. What are you gonna say, Jai? Sorry.
Yeah.
This fucking Lambro.
This might be an underrated point. I don't think I've heard many people talk about this point of, okay, what does it now mean to be an Aave depositor, right? It now means that the Aave DAO and the entire community is going to bat for you, right? I agree with Saul that, like, hey, this probably isn't going to happen again on a $300 million size. But does this mean that, like, Aave is too big to fail at this point, right? Because I know that everyone's talking about how a lot of liquidity moved over to Spark, right? And how Spark's token's doing pretty well after these last couple of weeks of events, right? But I think the bigger story here is, like, I'm a big fan of Morpho and everything that they're doing, right? But, like, why would you go to some random curator, right, in some random pool where they're going to say, oh, not my fault. Oh, I don't even have any skin in the game here, versus going to a bank, essentially, a bank-style product where their equity and their team and everybody is going to work their asses off to make sure you don't lose your money, because that's how they lose their kind of trust as a brand in the space. So I actually think that this is like, if Aave continues to pull through here, I think they'll come out much stronger than they went into it with, because people will trust them.
That is an interesting take. Like I was like scrolling this morning and I saw the Morpho founder must have been in podcast or something else. I forgot. But yeah, he was saying what you were saying. He's trying to position himself, we don't compete with Aave. We compete, like our asset managers, our builders compete with Aave. So in this case, that's what you're saying, right? So if I'm a curator, but somehow I've built a great enough brand and I don't have skin in the game, these are different than, like, I know some protocols these days are mandating the curators to at least put 1 to 5% of their own capital, which mimics the banking model, or which is kind of safe. That's the whole reason why like '08 happens, because you don't have to put your money on the line as the banks. So I think that's a very interesting point. Yeah, I wonder if you agree with that, bro.
Yeah, I mean, I think so. I was looking at a few things, right? Like on my side is that Morpho got 8B TVL, Spark got 1.4B. I actually agree with JB's saying of like it's actually positive for Aave that it got bailed out, because it's almost a different type of insurance, right? I know that they're probably going to do it again. It's proven that people care. But I was thinking from a token point of view, right? What happens to the governance if they get this bailout? Who actually makes the call? Because tokens are not equities, right? Like it's just not there. So that's what I was looking into. There's a few things, right? As token becomes the future revenue. Let's say we just assume the value is only in buyback, because the governance is proven to be less useful here in terms of the token governance. And the second is if this happens again, who are it? Because they're not the government. They're just a DeFi group of rich people. It's not like they're the US government where, all right, here we go again. Let's just save them again, kind of thing, right? So I've been debating after like the May vote, the governance vote, what would people think and what would happen actually. But I don't know. You guys probably have more insight in this. Maybe talking with the people in the industry, etc.
Got it. Okay. I mean, on this, I think it's a good segue to the next topic that we want to talk about, right? So all of this, basically, the lifebloods of DeFi are actually the lenders. But like if you, let's say you create a new RWA or like an off-chain yield source, shout out Saul, right? Like you as the issuer, you have the actual backings either in like MPC wallets or like your like banks, or even if it's like exotic products, we've seen a lot of Turkish money market fund or whatever, right? But those are actually being held in the banks, right? Like now you as the issuer, you launch it 1-to-1, you hold it, your minters or KYC or KYB and blah, blah, that's fine. The one that's like getting the burnt end of the stick are just the naked vanilla lenders, the folks who are like wanting to lend to all these baskets. And then of course there are curators that like just like creates like a product. Like if you deposit money here, we will like lend it into like CBBTC or like a couple of these assets, and we will manage that for you. Now, I do feel that everything that's been happening lately would increase the demand from these lenders. Like they might be happy with like 5.5%, but now they might want more, right? And I think that would create like a ripple effect, because that means that looping becomes more expensive. Like the curators would probably be more restricted in terms of what they can lend against. These days when you scroll your mouse into the Morpho markets, you might see a bunch of baskets of different assets, but now they might be like, hey, I only want to lend to like Janice Henderson money market fund or whatever, that's more boring like that, right? So I'm like trying to think, okay, what does this mean? There's this really great article that was written by Tom, right? He is like arguing that the fair value in his argument is it's around 12%, and he argues that like there's all of these additional risk tranche, like clerical risks, government risks, composability risk, blah, 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 and it should be around 12%. Now, there's also a good tweet from my old boss, shout out. She was replying to this article by saying that while this is true to some extent, this doesn't take into account that a lot of the DeFi capital are actually coming from, good in theory, but in practice, on-chain money market allocators are mostly unbrokered offshore capital owners, right? Chinese whales who value like a lot of these like non-coercion and blah, blah. So this model assumes that you can get easy access to the US capital markets, right? So like her argument, it should be more above the BBB rate, so around 8 to 10%, right? Yeah, just again, I'm just like sharing this to get like both of your reactions. What do you think about this? Like, do you think it kind of makes sense? Any like models that you like disagree?
Yeah, I think they're overpricing risk based on recent events. I also think that lending rates would likely be higher across DeFi if this were true, because we're at, ignoring the last few weeks, the borrow rates are like 3.5, 4%. That's nowhere near 10% or 12%. I don't think those are realistic at all. I think the underlying message of reducing risk in every single vertical of Oracle risk, governance risk, bridge risk, asset issue risk. All of these risks have to be reduced in order to get that perceived risk down and to get the burn rate down. But yeah, in general, I don't think 12 is nowhere near actually realistic.
Got it. Do you have any thoughts on this, Jai?
Yeah, I think my simple answer is if the fair value for risk here was 12%, we would see 12% yields on
Yeah.
right?
Make it simple. Yeah.
Right? But there's a reason why this is happening, right? I do imagine that a lot of it has to do with whales that live outside of the United States. I think a lot of it has to do with just like lazy capital. A lot of it has to do with assets that want to stay on chain for whatever reason, right? I think this is kind of what this tweet's hinting at, right? It's like, you want to go and off ramp it and deal with all of that bullshit, right? When you can just go on chain. And yeah, maybe you're earning a bit less, but now you can instantly go and buy Bitcoin whenever you need, you know? So that liquidity element is certainly extremely valuable, right? So that's kind of how I think about it. Is like, yeah, maybe hypothetically risk is underpriced currently. I agree with Saul. These models are probably way overpricing the risk. But at the end of the day, the only thing that matters is what is the risk settling out at right now, which is just historically sub 5% we're talking.
Got it. Okay, wait, just a very quick follow on. Oh, go ahead, Lembro. You're about to say something.
Well, I mean, so I agree everything everyone's saying. It's just that lazy capital and those Chinese whales, I think there's two parts, right? They're not growing the DeFi stack, like so it doesn't. They and likely they are more people that are more, let's say, I think a lot of DeFi, like Chinese DeFi whales actually know DeFi and they would be aggressive when the market is hot. So they won't grow the whole pie basically. So like we're stunned here where somehow someone need to bring this additional use source or we need activity to bring it. So like, all these statement doesn't change what percentage you want, bro. If I want, I want UST, bro. I want UST 20% APR with no risk for like 1.5 years until I die, right?
Right. No, like I was just gonna say this is more like an open questions for all of you. I mean, like as power users yourself, given what recently happened, how much yield would you be comfortable if you're depositing your own money, you know, in as a lender in this case? Of course, there's case by case, like who are the curators, which markets, blah, blah, but let's assume, you know, it's the safest. Yeah, what are you expecting these days?
Yeah. I think that what most lenders are doing implicitly is putting out an option to acquire the collateral at some discount, right? Mm-hmm. And I think if that was clear to the lenders that are participating in these lending markets, that they're submitting options to go and buy these collaterals, and these are the prices at which they are willing to buy, I don't think that most lenders would participate, right? Because I think that what we're seeing is in order to get the yields that you need, right, or the yields to be competitive, you might as well just go and hold the asset outright and get most of the upside instead of sitting a little bit more senior, but now submitting risk and basically spreading your risk across the worst of 8 or 15 or 20 collaterals. You know, this is why, as far as it comes to even my own farming, it's like, no, it doesn't make sense to be in a lender where I'm basically underwriting 15 collaterals, an option to buy at a liquidation price, which means it's doing its worst in all time if it's hitting its liquidation price, right? Instead of me just saying, hey, look, I would prefer to hold this asset outright, you know? And then obviously we can talk about leverage on top of holding that asset outright or ways to go and minimize the risk of holding that asset outright if that's something that a lender is not comfortable for. But I think the model of, hey, look, I'm going to unilaterally go and underwrite all of this collateral pool and offer to buy all of it at a discounted price when things are most depressed, I think that's just wrong.
That's very fair. Yeah, like it's that's a good way to like put it. That again, like all of these other like competitors are shilling their own edge when this happens. But you know, Syrup has been doing fairly well because at least I think for the lenders it's clear, right? Hey, I'm lending against Bitcoin, right? So it's a very clear structure in this case compared to when you hover your mouse and then you see, oh wait, shoot, I'm lending against 20 random assets, right? Yeah. So.
20 random assets at a 95% LLTV, and you're like, fuck.
Right. Yeah. That's fair. Okay, I think I want to move towards just like understanding a bit of your own area of specialty. Maybe I'll move to you first, Saul, for this. But yeah, I mean, you've been in DeFi for a long time. You manage a Discord group, and you see all of these yields, and you're like participating in one of the project itself right now. My question is, so given that you handle somewhat of an exogenous, I guess, off-chain yield source, right? Like, how are you seeing that trend happening? Do you see just the same repeated thing, but more mature, like invoice financing, shipment, whatever? Are you like seeing more of that other than just like reinsurance, for instance? I'm not talking about like specifically, but just broadly, how are you seeing this exogenous yield source coming into the markets? Are you seeing any trends and patterns and so on?
Yeah, I mean, I think there's a big pattern in bringing these kind of uncorrelated yields into DeFi. Whether it's Haster with Prime, they've been insanely successful. I would even call Syrup kind of uncorrelated. Yeah. They're lending to institutions, even though it's against crypto. It still counts. There's a lot more. There's reinsurance with us and Henri. There's Brazilian credit. There's a lot of fun stuff people do. There's a lot of trends with private credit, which I'm not the biggest fan for. I think people are here to sell you bad private credit and get you into it. So in general, I think it's a good move for DeFi to get uncorrelated yield, just so we can kind of scale more TVL into DeFi beyond just farming the basis trade. So in that sense, I think it's positive, but I think people have to be careful what they deposit into. There's a lot of bad real world assets that people bring here because they cannot sell it in the real world.
What's one or two diligence tips, just if you're telling your friends, hey, Saul, I'm looking at this RWA that I'm being pitched at by Chain Z, right? What should I look at first here?
Yeah, I mean, you have to really get a thorough understanding of the underlying. I don't think you should just jump in seeing yields, not knowing what it does. I think it's very unreasonable for you to deposit into something you don't have an understanding of. So make sure you understand all the mechanics of the underlying. Make sure to understand how you can get out. That's probably one of the most important things. How quick are the redemptions? How big is the liquidity? What is my worst case here? What will happen if they, lose some money? What wipes me out? What ruins this farm is basically what I would approach.
Got it. Segue to you, Jai. I mean, I want to talk a bit more about your product. I mean, you have briefly mentioned it at the beginning of this call, but the concept of tranching, I think, is one that a lot of people are quite familiar in the TradFi markets. But if you can just do a very quick recap of what that is and how you see that would evolve, that would be great. Yeah.
Cool. Yeah. Maybe I can explain kind of how we started doing this, right? Because it gives a good background, right? About maybe 9 months ago, we were seeing a lot of the on-chain yield programs shutting down, right? They just couldn't continue to pay for token emissions, and they didn't want to pay their token emissions. And what we saw was the rise of these off-chain yield programs happening on-chain, right? So great projects like like Maple, all sorts of different ones coming on-chain, both shit ones and great ones, And what we realized is hey, look, there's kind of two different demographics of crypto natives that are coming online, right? There's the more traditional asset managers looking for some amount of yield, right? They're returning a fund, they have LPs, and they aren't trying to go crazy on smart contract risk or anything. They're looking to just make sure that their investors get some good return, And then at the same time, there's this crypto native capital group, right? The ultra degens, And what we realized is, look, a lot of these yield programs, they're coming on chain, right? And they're maybe landing between 13%. Now, that's difficult for a crypto native to go and underwrite. That's not enough yield. That's not enough return for me. And that's difficult for an institution to go and underwrite because usually that's a good amount of risk, right, that they would need to go and underwrite. So what we said is, okay, what if we had the ability to take any sort of yield token, whatever it might be, take it into a protocol, and we could split it into two capital pools, a junior tranche, right, the high risk tranche, the first loss tranche. So if losses occur, the juniors are the first to lose their money, right? Proportionally to their size, right? So usually we see junior capital pools being about 10 to 15% the size of then the senior capital pool, right? That senior capital pool is now a lower risk because it's being protected by that junior capital pool. It's a lower risk pool that we can go and work with institutions on allocating into, and they can feel comfortable going and doing so because a junior tranche protects them. What we've seen with the rise of all of these RWAs as well is a lot of these issuers, right? They want to differentiate from really, really crappy issuers, right? So we're working with a lot of them on actually posting the junior capital themselves, so that they can say, hey, look, I have real skin in the game. You can prove it on Royco, right? We can see our junior capital deposit here. And now you can feel comfortable going directly into that senior. And that is something that we're really excited to be working with a lot of different issuers on.
Got it.
What kind of ratio are junior tranche and senior tranche like in terms of I guess TVO?
Yeah, so in our system, we define a minimum, okay? There's a lot of tranching systems out here that don't have a minimum, which means that maybe today your junior tranche is 10% of your senior, but for all you know, when a hack comes around, it ends up being 1%. And that doesn't actually, that doesn't mean anything for a senior depositor. That doesn't transform the risks for the senior depositor, right? So our system defines a minimum coverage.
Ratio.
That minimum coverage that we define usually lands between 5 and 15%. And now that we're onboarding more volatile assets, that's going to go up, right? So soon we're going to have HLP on the platform where you can start going into a senior of the HLP. You can go into a junior of the HLP. That's really attractive, right? But there we're pushing minimum coverage up to, I believe, 30 or so percent, So now any drawdown between 0 and 30%, senior's good, senior's safe, And then now that junior capital pool is getting a really, really great rate of return there.
Nice,
dude. One thing that I'm always just like, man, this is exciting, but somebody's gonna get burned. Is without naming names, funds that are tokenizing their own NAV, they're tranching into junior, and then they use their own NAV to loop down their own funds, and then it becomes 5x of their I'm like, oh my god, man, it's such a cool concept, but somebody's gonna get burned one day. But yeah.
I'm gonna get heartburn from just thinking about it, man.
Yeah, but anyway, I wanna give the floor to both of you if you have any questions for us, or just if there's any specific topic that you wanna cover, given all the recent exploits. But again, thanks for your thoughts and time for this discussion. It's been a great one.
Yeah, I have one question for Saul, which I think would be interesting. Is we kind of touched on it, but I'm curious how you guys are thinking about generally with all of this stuff going on, right? Depositors are going to be way more cognizant of security. Depositors are going to be way more cognizant of the capital waterfall. Depositors and curators, any lender, right? They're all going to be really going and auditing the full stack now of probably all of their positions. I'm curious, what, if anything, are you guys doing to kind of react to that and show, hey, look, as an off-chain project, you can go and validate all these different things to make sure that we're good end to end?
Yeah, for sure. So I think the last 2 weeks or so, our development team was just going through the whole stack and making sure we can reduce risk as much as possible. On one hand, it's reducing the amount of mid assets we do for minting our assets. Then it's setting up PagerDuty so we can get instant responses. It's setting up Oracle backups. It's various things we do just to reduce risk as much as possible.
Hypernative, couple others, but yeah.
Yeah, then we're working on. Yeah, we don't currently have Hypernative yet, but that's also work in progress. We're working on improving transparency as much as we can with Accountable through our own dashboards, just so people get a better understanding of the reinsurance risk. Then there's the side of our on-chain backing. In that case, we're thinking about reducing risk as much as possible there, because our tranching system currently only involves the reinsurance risk. So since we already bring the yield through reinsurance, it is very likely it's worth it for us to just sit in T-bills or something extremely risk-off and not SUSDE. This is still a work in progress, but I think it's a reasonable thing for us to do.
Cool. Do you have any questions, Saul?
No, not really.
No worries, man. All right.
But I have a question for everyone. Let's start with
away.
JB. What do you think is required to make it in crypto?
Oh, it's our classic question.
Maybe some mental illness to get started.
That's a good.
Right? Realistically, you need some amount of crazy, how to put it, ability to deal with shit, you know, and some persistence that certainly is not normal to expect from people, you know, right? In order to make it, you gotta survive. Survive really hard.
Go on.
100%. 100%.
Yeah, I agree.
Be a cockroach.
I mean, like, I think crypto gave me the ability to just not emotionally react to stuff. Like, imagine you're in a bad trade. You gotta need this poker face, a rational look at what's happening. So yes, you definitely, if you truly want to succeed, you need to make sure you don't get wiped out. You need to make sure you're as not risk off as possible, but a lot of people don't truly assess their risk.
Yeah.
So just do more due diligence, basically. Beyond that, I mean, don't be a scammer, I guess. Like, and that's it.
Try not to round trip, man. Yeah.
Round trip is a must, bro. I think round trip is a
On your
must.
first
Don't be
cycle,
greedy.
yes. Yeah.
Don't be greedy that you need to make scammer money, and be happy with making enough money, I guess.
I want to make so many jokes right now, but I'm gonna get canceled. But like, anyway, okay. Thanks, guys. This has been a great one. We should do this like every few months or something like that. Maybe with like a new guest, you know, like a DeFi powerhouse or something. But again, appreciate both of your time. Please check out both of their like X account. Like all of that would be on the show notes. Jai from Royco, Saul from Yields and More, and Ree. And that's it for today's session. I'll see you guys next time.
Thanks for having us.
Yeah.
Cheers, guys.
Thanks for having us.
Bye-bye.
Bye, guys.